Okay, so let's go a little bit deeper into price action because today we are going to talk about like one of the concepts that people know the worst. It's insane. Like I was streaming for the whole of May, and this was last year, and it was so funny always hearing people say, "Oh, SMT divergence. Oh no, we had an SMT divergence." And it's so stupid because it was always wrong. And the time that it was right, they would be like, I told you, Kimmel, there's an SMT divergence. They would completely ignore the fact that they were wrong 99 times in a row. And the one time that they were right, they were like, yeah, I told him about the SMT divergence. He didn't listen. But guess what? You are all using SMT divergences wrong. And that's why this video is going to clear everything out. So welcome to the bootcamp yet again. Let's talk about this. Let's talk about SMT divergences because what people don't understand is that the SMT divergences, they tell you a lot on what pair to trade and what pair not to trade. They tell you when to trade and when not to trade. They tell you so many things, yet you use it in the wrong way. And so in this video, we are going to learn how to use it the right way. So first of all, let's talk about what an SMT divergence is. Well, an SMT divergence, it's basically when two pairs that should correlate, let's say for example, euro dollar and pound dollar. These two pairs, they should technically correlate, right? They should basically move the same, which means if euro dollar is moving to the upside, then pound dollar should be moving to the upside. This is usually the case because the only difference between euro dollar and pound dollar is the pound. One of the key pairs is a commonality, right? So we have euro and the pound versus the dollar. These two should be moving very, very similarly. There should not be that big of a difference when it comes to euro dollar and pound dollar. Next example is what? It's NASDAQ and S&P 500. These basically, they track different markets, but the price action should be very, very similar. If NASDAQ is moving to the upside, the S&P 500 should be moving to the upside because the overall stock market should be moving to the upside. That's basically what it is about. Now, when this does not happen, this is when we are going to see SMT divergences. But the problem with SMT divergences is that people use it wrong. Why? So, SMT divergence, the number one concept, the number one way for you to understand if it's the right time to use an SMT divergence is asking yourself, are we in a high value area? Because if you are not looking for trades, you should not be looking for SMT divergences. And what that means is that so many traders, what they do is that they look for an SMT divergence and then they look for an entry. When in reality, you should be looking for an entry before you look at an SMT divergence. This means that an SMT divergence is basically a good way for you to understand what pair is the best for you to enter on. But if you're not even thinking about entering, you should not be looking at SMT divergences at all. So let me tell you, the only way, let's say that we have NASDAQ and S&P 500. So let's grab here, let's do NASDAQ and let's do S&P 500. So if we have, so by the way, this is where we have NQ and ES on futures. But no, you know what? Let's even do pound, because pound and euro, because we mostly trade those pairs. So let's look at euro dollar and let's look at pound dollar. So by looking at euro dollar and by looking at pound dollar, both of these pairs, they should be moving the same. And so usually when they are at a high value area, so let's say we have a big daily order block. So let's say that we are on the daily. So let's do 1 day right here. So let's say that on the daily, and we'll put a separation in the middle. Let's say that on the daily, we are currently at a big daily order block, right? So both of the pairs are going to be bearish. This is a order block, a bearish order block. And then pound dollar is also at the bearish daily order block right here. So now we are zooming in into this price action because we are interested in shorting both pairs, right? We are interested in shorting both pound dollar and we are interested in shorting euro dollar. And I'll show you some examples in which you can see this happening also on the daily, and you will be able to understand what is the right pair to trade. So once you have the bias of euro dollar is bearish and pound dollar is bearish, okay, you have the bias very clear. If you don't have a bias, you already know you should not be trading. But let's say you have a bias. Euro dollar and pound dollar are bearish, which means very likely DXY is bullish. And so we are now at a high value area. So your next question is, what is the best pair that I can trade? What is the best pair? What is the pair that is more likely to reach the low first? Is it pound dollar or is it euro dollar? Because if it's pound dollar, you will want to short the most bearish pair. But if it's euro dollar is the most bearish pair, then you will want to short euro dollar. And you ignore the other one. Even though there's still the likelihood that, let's say, euro dollar is most bearish and pound dollar is also bearish, but not as bearish as euro dollar, and we'll be able to define this still in this video, then, and pound dollar still is the pair that moves the most, you are still going to be confident in your analysis. Now, let me show you something. A lot of traders, when they think about SMT divergence, they think it very much the wrong way because they just become retail in terms of what an SMT divergence is. So let's talk about SMT is. So SMT is basically when we are bearish. So let's say we are bearish and one pair has formed the higher high while another pair has failed to form a higher high. And at this point, we are at high value area. But what is the issue? Well, a lot of traders, they see this and their number one thing that they will want to do is now long. So let's say that once again, this is GU and this is EU. The bias is bearish. Let's push this up. Okay. So a lot of traders would actually look at this and want to short pound dollar because pound dollar has now swept the high. And euro dollar still has to catch up and still has to sweep the high. Not understanding that that is the exact wrong way to think about it. Because right now, what have we talked about? The bias is clear. The bias is bearish. We are at high value area. So 2 points have been checked. So now we are looking for trades, right? Since we are already looking for trades, the next thing that you are going to do is you want to look for the most bearish pair because you want the pair that aligns the most with your bias, that is more likely to tank more. And that's where you are going to look at these signatures in price of where you see pound dollar forming a higher high while euro dollar is not able to form a higher high. And while so many people are thinking that that means that euro dollar still has to catch up, you right now have to understand that what this actually means is that euro dollar is still on an uptrend while euro dollar is failing to continue the uptrend. So right now, what is the most bearish pair? If euro dollar has failed to form a higher high and pound dollar has formed the higher high, what is the most bearish pair? It's the pair that wasn't even able to sweep the high. If a pair is not able to go with the other in forming higher highs and higher highs and higher highs, that means that that pair, when it starts dropping, it's going to drop like a rock. And that is the type of signature in price that you want to be looking for. And so from the point on that we see that we are very clean bias, very clean high value area, we are going to be looking for the SMT divergence. We are going to be looking in terms of the pair that was not able to form the higher high, because that is going to be the most bearish pair, because that is the pair that is going to start tanking way more than pound dollar. So the highest probability trade is going to be on euro dollar, and we've seen that happening recently on euro dollar and on pound dollar. So let's quickly go into the price section recently on euro dollar and on pound dollar. So I want you to check something. So before we go back, so I want you to check the price section between euro dollar right here, right? So let's do this, open the new tab, and let's do this. Also, open in a new tab. So if we are checking the euro dollar chart, okay, so I have to reduce my camera a little bit. On euro dollar, let's do the analysis. What can we see? What can you see in price? You can see that we are at the daily order block right here. These two up close candles, these are a bearish order block. And this is very important. Notice how this most recent fair value gap has gotten inverted. This fair value gap has now been absolutely disrespected. So now this is an inverted fair value gap, which means it's bullish, which means that there is support, which you can see price reacting from. While on pound dollar, notice how this fair value gap has not been breached yet. This fair value gap has not been yet disrespected. And notice where pound dollar is. Pound dollar is way more bearish than euro dollar, because pound dollar is still far away from the order block, from the daily order block, these two up close candles, while euro dollar is currently resting there. Euro dollar has not been able to break through, while pound dollar keeps on moving lower and lower and lower. So why do you think that I entered on this trade on pound dollar and not on euro dollar? It's because pound dollar is the most bearish pair. So if I am bearish, the trade that I want to execute on is going to be on the pair that is more likely to play out. So we had everything. We were at the daily fair value gap. The bias was bearish. So we are at a high value area and the bias is bearish. On the daily, instantly on the daily, you can see that the most bearish pair is pound dollar. So if you want to execute on longs, you execute in line with the most bearish pair. That is exactly what you have to do, right? So now let's see recently, this is happening right now. This is happening right now in price. Notice the difference between NASDAQ and S&P 500. Can you see how NASDAQ has failed to form a higher high in this exact candle right here? In this candle, this bullish candle on NASDAQ is the same as this bullish candle on the S&P 500. So if you longed NASDAQ, you would have not even gotten to the high, while if you longed ES, meaning S&P 500, and your target was this high, you would have taken profits. But let me tell you, the way you are now going to see this, and I'm not telling you to trade this exact price action. I'm personally not even trading this exact price action. It's that you pair this with your bias and you'll have a killer setup, way more likely to play out. So if you want to long, you have to be longing S&P 500. If you want to be shorting, you need to be shorting NASDAQ at this precise point, because you can see the signature in price. S&P 500 keeps forming higher highs. NASDAQ is failing to form higher highs. You don't see them forming, right? So let's see, 2 candles in a row. This one formed a higher high. This one did not. Those are the same candles, right? This high is the same candle, right? On S&P, this was breached. On this one, it was not. That's what is important for you to keep in mind. Because so many traders see this and they think, oh my God, this just means that now I have a way higher risk to reward for NASDAQ. So I'm going to execute on NASDAQ. When in reality, you're just shooting yourself on the foot. When you are bearish, you want to trade the most bearish pair. When you are bullish, you want to trade the most bullish pair. So if you are bearish right now, you are going to be wanting to trade NASDAQ and you want to be targeting this low. And you will see that NASDAQ will reach this low way quicker than S&P is going to reach this low. But if we are going higher, you will see the S&P reach this high way before NASDAQ reaches this high. And the way you use this is by understanding if you have a bias, if you have a high value area, you want to be looking for the signatures in price that show you what is the best pair for you to trade according to your direction. And that's when you are going to figure out if it's going to be euro dollar, if it's going to be pound dollar, if it's going to be S&P, if it's going to be NASDAQ. So that's how we actually use that's how we actually use SMT divergences. Because so many people are like, no, but so many people use SMT divergence as a way to enter. That is so stupid. It's incredibly stupid. You use SMT divergences as a way to choose what correlating pair you are going to use. What correlating pair you are going to execute on. That's what you look for. Nothing else. So it's incredibly important for you to understand what the best way of using SMT divergence is. And I hope this video helped. And that's going to be one more confluence for our entries. When you're looking for the reversal, when you are looking for the continuation entry, one extra thing you should do is choose the right pair to trade. So that is basically it. Hope you enjoyed, and I'll see you tomorrow. Just a quick update on what we were talking about. I want you to see how NASDAQ has not reached the high yet, the 1 hour high. And if we check ES, it has reached the high. It has already reached it 1.5 hours ago, while NQ has not reached it yet. And again, if you were biased, if your bias was long today, you would have been way better off trading ES than trading NQ. So this is why the SMT is incredibly important. And it's not only the SMT, it's understanding what is the most bullish or most bearish pair at any particular time.